So we are today at 24 PE multiples as far as Nifty is concerned. Mid cap and small cap is very, very expensive, we all know. We are in mutual fund distribution for almost 15, 16 years, kind of that. This kind of euphoria or this interest building up by retail investors is reasonably confusing us. And we want to hear from you, because you are a fund manager, right? Is it really, because majority of the market is doing well. There are only very few areas which is not at its optimal value or whatever it is that valuation is concerned. So is it really becoming difficult for fund managers to select stocks, or which sector money has to go? How exactly you are building portfolio? Because you are a mutual fund manager, you will have a bigger issue of sizable inflow, sizable outflow, right? This is a standard problem with any mutual fund company, right? So how easy for you to select stocks, give good returns, because investors comes with their own set of expectation. How exactly you are seeing this particular issue of market peaks, and how returns can be?
See, I think if we look at what has happened in the last 4 years, I would say this is very, very unusual period for equities, where not only equities have given phenomenal returns, much more than the average returns that anybody would have imagined, but also it has come with very, very low downside volatility. There have been hardly periods where people would have questioned their investments or had seen correction in the market. That cannot be a normal scenario. And going forward, as we spoke earlier as well, the valuations will come into play, the volatility will come into play. Equity is an asset class where volatility is inherent to the asset class. We should always remember that. And as valuations are higher than long-term average, there could be potentially periods where market would correct and come back to average valuations, or there could be cases where it goes even below long-term averages. So to that extent, we should all keep that valuation in mind. What is the current valuation? What has been the historical valuation level? And given that the current valuation levels are higher, how should we manage our risk through asset allocation? Right? Coming to our own take on the markets, usually when the valuations are very, very attractive, especially after a period of very, very strong panic-led market correction, like what we saw after 2008 global financial crisis, or during the COVID disruption, you are actually investing in the market at very, very attractive valuation levels. So there is a chance that many sectors perform uniformly well. I think that period is over. Now the valuations have not only moved up, they have moved beyond the average valuation levels historically that we have seen. So to that extent, I think now it becomes very, very important that rather than betting on entire sectors, you need to see from a bottom-up perspective which are the companies which are still likely to do better than the rest of the market or the average market in terms of the earnings growth, and also see whether we are overpaying for those businesses. Or we are paying right valuations. Because if you are overpaying for a good business, it may so happen that the business still continues to grow, but because of the overvaluation, you may not get any returns in the bargain. So these are the things that we always keep in mind when we are constructing our portfolio. And also we keep it diversified. We don't put all eggs in one sector. And we try to take measured approach in terms of what kind of portfolio weights that we can assign to each of those businesses. So there is a way in which we manage the risk for our investor.